Hey there, fellow traders. Welcome to another episode of AM Trading. Today, we're diving into the fascinating topic of Fibonacci retracement levels. Fibonacci retracement levels are powerful tools in technical analysis that enable us to predict potential levels of supply and demand before impulsive moves take place in a trending market. However, it's important to combine them with other forms of analysis to make well-informed trading decisions. In this video, we'll provide you with a step-by-step demonstration on how to correctly use Fibonacci retracement levels. By doing so, you'll gain a deeper understanding of price movements and significantly enhance your trading decisions. But that's not all. We'll go the extra mile by sharing two of the most effective entry setups for continuation and reversal trading using retracement levels. It's a comprehensive guide designed to take your trading game to new heights. If this piques your interest, hit the like button and subscribe to show your support. Now let's delve into some fundamental concepts about market structure. Regardless of whether you're trading in Forex, crypto, stocks, or other financial markets, it's crucial to understand how prices move in waves of impulse and pullbacks. This fractal nature of the market occurs due to the behavior of market participants. When market sentiment is bullish and traders are optimistic about a currency pair, they tend to buy it, resulting in an impulsive move in one direction. However, as the price rises, some traders may consider the currency overvalued and decide to take profits. On the other hand, some traders might go short, triggering a pullback or retracement. Conversely, when market sentiment is bearish and investors are pessimistic about a currency pair, they tend to sell it, leading to an impulsive move in the opposite direction. As the price falls, some traders may perceive the currency as oversold and decide to buy it back, which can once again trigger a retracement. Impulsive waves often push the price to a greater distance with momentum, characterized by candles of the same color and big bodies. On the contrary, retracements represent a form of indecision on the chart, featuring candles with combined colors, small bodies, and sideways wicks. Identifying the end of a pullback and the start of an impulsive move can be highly profitable, as it allows us to capitalize on potential buying or selling opportunities in the market. And this is where Fibonacci retracement levels come into play. Fibonacci retracement levels are horizontal lines placed on a price chart to indicate areas of value during a trending market. The main retracement levels are 38.2%, 50%, 61.8%, and 78.6%, which can serve as potential trade entry points. Now let me guide you on how to effectively use retracement levels on your chart. Imagine we have an uptrend with a series of impulsive and corrective moves. Our goal is to identify the most recent impulsive move and wait for a pullback to enter a long position at a better price. To begin, grab the Fibonacci retracement tool on your charting platform. Simply click on the start of the impulsive move from the bottom of the wick and then drag the tool to the top of the movement. This action will generate the retracement levels displayed on the right side of the chart. When the price pulls back to these levels, they can act as a form of support and potentially reject the price, leading to further upward movement. However, it's important to note that pullbacks come in various shapes and sizes. There are two different types of pullbacks: small and deep pullbacks. A small pullback, ranging between 38.2% and 50% retracement, indicates a strongly trending market. On the other hand, a deep pullback, occurring between 50% and a previous level of support, signifies weakness in a trending market. Now the question arises, which retracement levels should we focus on for optimal trading decisions? To answer this question, we divide the potential pullback range into two parts. The area above the 50% retracement level is known as the premium, while the area below is called the discount zone. Let's explore this concept in the bullish scenario. Attempting to buy the asset in the premium area can often result in losing trades, since the market tends to take out early buyers and benefit from liquidity. On the other hand, looking to buy in the discounted area may cause you to miss many trades in a strongly trending market. However, it could lead to high risk to reward ratio trades. It's essential to note that the same concept applies to the bearish scenario as well. These were some of the basic concepts regarding market movement and retracement levels. Now, let's progress to the advanced phase, where we'll demonstrate how we utilize Fibonacci levels to generate trade entries. Usually, we combine retracement levels with price action in two major ways: trend continuation trading setups and reversal trading strategies. Let's start with the trend continuation setup using retracement levels. This setup focuses on the 78.6% Fibonacci retracement level and is best used in pairs with deep retracements, such as gold. It is a trend continuation setup, so it works well when you can clearly identify the ongoing trend. For example, in an uptrend with higher highs and higher lows, we identify the most recent impulsive move from point A to point B and wait for a pullback to enter a long position at a better price. Considering that we are in an uptrend, there is a higher chance for the price to retest point B before breaking point A, indicating a major trend change. To enter the position, we use the retracement tool from A to B and set a buying order precisely at the 78.6% level. Our stop loss is placed a few pips below point A, and we target point B. This provides a risk-to-reward ratio of approximately 1 to 3. Now, let's dive into the details of this trading setup step by step on a real chart. For instance, on the 1-hour time frame of gold, we observe an obvious downtrend with impulsive moves and pullbacks. Applying the retracement tool from the start to the end of the recent swing, we place our buying order precisely at the 78.6% level. If the market experiences a deep pullback to grab liquidity, we have a high probability trade entry. With a risk-to-reward ratio of 1 to 3, a winning trade can compensate for 3 losing ones. To execute more precise entries with this trading setup, there are 2 factors to consider. First, account for the spread. The price often reacts to the 78.6% level within a pip, so it's crucial to place your order with a spread size above that level or choose a broker with tight spreads. Second, analyze the higher time frame market structure. Understand where the price is coming from and how much room it has to continue before reaching higher level demand or supply areas. For example, if we zoom out to the 4-hour time frame, we may identify a higher time frame demand area. If there is ample space before reaching it, short positions may be suitable. However, if the price has recently encountered a higher time frame demand level, opening a short trade without confirmation could be risky, as the market might easily change direction and disregard lower time frame supply areas. I hope this explanation clarifies the concept for you. If not, let's explore another bullish example. On the 1-hour time frame, we observe an evident uptrend, with the latest impulsive move and staying above the swing low indicating an ongoing uptrend. If the market pulls back to the discounted area, it would be an excellent opportunity to enter a long position. Before placing any trades, let's analyze the higher time frame to gain a broader perspective. In the 4-hour time frame, we see a recent break above a key supply level, indicating that demand is in control. Additionally, there is ample room for the price to continue before reaching the next resistance zone. This alignment of higher and lower time frames in the bullish direction supports our decision. To execute the trade, we apply the Fibonacci retracement tool and place our long position at the 78.6% level. The stop loss is set a few pips below the swing low. Determining targets is subjective, but a safe area to secure profits could be the close of the lowest candle. Before we proceed further on the reversal trading strategy, I would like to remind you to smash the like button to show your support and share your thoughts in the comment section below. Reversal trading presents challenges as it involves trading against the prevailing trend. However, it offers the potential for significant risk-to-reward ratios. The trading setup we will now discuss combines 3 key elements: a major level of structure, double top and double bottom patterns, and retracement levels. Let's begin by exploring the concept of a major level of structure. This refers to an area that has consistently acted as both support and resistance, exhibiting multiple rejections and recent respect. Such levels of structure often generate highly accurate trade entries. When price interacts with these areas, it frequently experiences a bounce, presenting favorable trading opportunities. Another component of this setup is the double top and double bottom patterns. These reversal patterns, characterized by an M-shape double top or W-shape double bottom, are widely used by price action traders. It is important to adhere to a simple rule when identifying valid double top or bottom patterns. For a double top, draw a box between the highest candle close and the wick of the first test. The second test's wick must touch or exceed the boundaries of the box, while the body should not close beyond it. To complement these patterns, we incorporate retracement levels. These levels, based on Fibonacci ratios, indicate potential areas of support and resistance where price is likely to retrace after a significant move. In this trading setup, retracement levels serve to confirm the validity of the double top or bottom pattern and identify potential entry points for trades. Allow me to guide you through the process of setting up a reversal trading strategy, step by step. In this strategy, we utilize 2 time frames to analyze the market and identify potential trade opportunities. Firstly, let's focus on the higher time frame. Here, we analyze the market direction, overall structure, and search for a significant level of structure that could potentially reject price movements. By observing the market from this perspective, we can identify that it was previously in a downtrend until reaching a particular price level. Subsequently, the market failed to establish a lower low, indicating a loss of downward momentum. Furthermore, the price broke through a key supply level, suggesting that demand has taken control. We also notice a major level of structure that has recently been rejected multiple times, acting as both support and resistance. Thus, if the market reaches this level again, there is a high probability of price rejection, presenting a potential buying opportunity. The next step involves patiently waiting for the price to test the key level of structure on the higher time frame. Once this occurs, we zoom into a lower time frame to execute our trade. On the lower time frame, we search for a valid double bottom pattern as an indication of a potential reversal. Once the price breaks the neckline and completes the double bottom pattern, we apply the retracement tool from the start to the end of the upward move. Placing our buying order precisely at the 618 retracement level enhances the likelihood of a successful trade. To manage risk, we position our stop loss below the swing low. Additionally, we set our target to reach the next level of market structure on the higher time frame. For instance, let's consider the gold 4-hour time frame, where we recently broke the supply levels, indicating that demand is currently in control. If the market retraces to this level, it presents a favorable opportunity for long trades, given that it is a significant level of structure that may potentially reject price. At this point, our focus is to patiently wait for the price to tap into this zone and then zoom into lower time frames to identify entry signals. Examining the 1-hour time frame in more detail, we can observe a triple bottom formation, strongly rejecting the price. The neckline of the pattern has been broken. However, it is important to note that entering the market at this moment would result in a stop loss that is too large. Therefore, it is advisable to wait for a pullback, which offers a more favorable entry price. To manage the trade, we apply the retracement tool and place buy orders at the 618 Fibonacci level. Our stop loss is positioned below the swing low, ensuring protection under any circumstances. We also recommend closing half of the position when the price reaches a level equal to twice the initial risk, enabling the trade to break even. Finally, we close the full position when the market taps into a higher time frame supply level. By following these steps, you can effectively implement a reversal trading strategy with a comprehensive understanding of market analysis and appropriate entry and exit points. That's all for this video. We hope this step-by-step guide has provided you with valuable insights into the process of setting up a reversal trading strategy. Remember to practice in a demo account before implementing these techniques in real trading situations. Thank you for watching, and we wish you profitable and successful trading experiences.